I am quite concerned about the health of the S&P 500 over the short term. I'm going to show you in this video why, and then I'm also going to show you a couple strategies for dealing with this situation. Hi everybody, my name's Joe. I'm a professional full-time trader with 28 years of trading experience, but of course this is not investment advice. This is just for entertainment and education purposes only. Now the reason I'm concerned is because of the sudden decay or deterioration in the breadth of the number of S&P 500 stocks in uptrends. Let's take a look at here's the S&P 500 1-year chart, and here was that nasty lump of coal that Jay Bring the Pain Powell brought to us on a rate cut announcement day, where he dialed back the number of cuts, etc. What I'm concerned about, this briefly broke the 50-day moving average, but it has regained it, bounced off it on Friday. Technically that looks okay, but my concern, if we go up here, this squiggly little worm chart here is the percentage of S&P 500 stocks above their 200-day simple moving averages. When a stock is above its 200-day simple moving average, it is considered to be in an uptrend. And in a healthy stock market, most stocks, are in uptrends. What we see here is since August, the breadth of the S&P 500 has been relatively flat. Between 70 and 80, we had this little false alarm here, but between 70 and 80 oscillating back and forth. And during that time, we had a pretty decent uptrend. But you'll notice a couple weeks ago, breadth began to fall off sharply right before Jay Powell gave us that lump of coal. And as you can see, it's not really getting much of a bounce. Now let's zoom out to, this is the, a 20-year chart of the S&P 500, sorry, 10-year chart of the S&P 500. Let me fix this here. And you'll notice that so it broke about, let's call it 60%. When the S&P 500 over the last 10 years has broken the number 60% of stocks above their simple moving average, 200-day simple moving average, we will notice that a pullback has ensued. So if we look right here, so here is the break in the moving average, and if you look down here, here is a downtrend of several weeks, right? First break of the 60 right here, little pullback, break of the 60, little pullback. This was the big sell-off in 2022, breaking the 60% mark right here in January 2022. And look at that huge sell-off. No, I don't think we're going to have a sell-off of that magnitude. Let's see. After flirting with that level, broke 60% right when COVID hit, and we all know we had that huge breakdown, and that's kind of an anomaly. Maybe we'll ignore that one. But here we see the breadth of the market relatively flat in 2017, and then suddenly we get a break below 60% and a pretty substantial pullback of 60 trading days ensued. Can we go back any farther? Here we had a relatively flat market back in 2015, break of about 60%, and if we scroll down, we have a little breakdown here. So it seems like now the odds are that the S&P 500 is going to pull back for a few weeks, given that we just got bad news from the Fed, given that there's going to be some turbulence as the presidential torch is handed over. This would make sense from a socio-political scale. So a couple other things. Let's think about how far this is going to pull back. One thing to note, when when breadth comes down to an abysmal 10%, when only 10% of S&P 500 stocks are in uptrends, that has marked the bottom several times in the last 10 years. September 22, June 22, March 20, January 4th, 2019. So if this comes all the way down between 20 and 10, that will be our signal that will bottom soon. But I don't think it's going to pull back that far. Here is my theory on the pullback, and then we'll talk about what to do about it. So I suspect, I'm looking at the SPY 1-year chart now, which is the ETF equivalent of the S&P 500. I suspect that we get a several week pullback here like we had in midsummer. This was a 14 trading day pullback. Right now we're sitting at a 6 trading day pullback. So maybe 2 or 3 more weeks. And it seems like the market probably, even though it did bounce off the 50-day, which was great, but it seems likely that it's going to come back down and get close to the 200-day and then probably bottom out. I wouldn't be surprised if it bottomed out on Inauguration Day, January 20th. Maybe it doesn't come all the way down to the 200-day. Maybe it bottoms out, this was about 3% above the 200-day. So let's talk about what will negate this thesis, and then most importantly, what we can do about it. So to negate this thesis, this was fairly bullish action on Friday. We did get some buying on the 50-day. I think to negate this thesis, simply we would want to see some sideways action and then a close above this prior high, which is 607.03. So if the market closes above 607.03, then this thesis, thankfully, is wrong. I don't think that'll happen unless we see a corresponding widening out of the breadth. So we would want to see the market coming up, and we'd want to see the number of stocks above the 200-day coming up. And certainly that could happen, and I hope it will, because I have a big long position in the SPY, but I don't think it will. So now, like I said, I'm a bit bearish for the next few weeks. So what do we do about it? Depends on your time scale. If you are doing a 30 or 40 or 50-year hold of the S&P 500, maybe selling some high points and adding on low points, then what I would do, this is not financial advice, is nothing, right? We are sitting 7.75% above the 200-day. I personally am highly doubting it's going to go beneath the 200-day unless we see some, radical erosion in a force majeure, so to speak. So, and given it probably won't even come all the way down to the 200-day, maybe it'll be a few percent off. So we are looking at probably only a 7% pullback or so. Now that's going to be painful if you have a big position in the SPY, but it's probably, like I said, only going to be 2 or 3 weeks. If you're a long-term holder of the SPY, I probably would just, be patient, try not to panic when you see it rolling down towards the 200-day. Now, if it crashes through the 200-day, then that is, of course, a different scenario altogether. So that's one thing you can do. Another thing we could do, if you are swing trading the SPY or just hate losing money, is we could sell here and then reopen when it breaks, when it goes to an all-time high. Or we could put a tight sell stop beneath Friday's price action, 590.75. That'd be another option, and move our SPY position into cash. We could stop out at 590.75 and then go short the SPY and try to short it 4, 5% or so. Another thing you could do, there's a triple leveraged ETF called the SPXS, which goes up when the S&P 500 goes down. And during the pullback in midsummer, this went up, the SPXS went up 34%. Now, I'm not saying you get that. We would get that this time around. But if the SPY comes down, let's say 7%, then we would get 7 times 3, 21%, although not quite 21% because of decay. I'll point that out. I'll explain that in just a moment. So what we could do, we could put a position on the SPXS that is 3 times smaller than our SPY position, just to kind of balance those two out. If you want to be more aggressive, you could close your SPY and just go along the SPXS. You could gradually tiptoe into the SPXS. And in terms of stops, instead of putting stops based on this chart, I would put stops on the S&P 500. So let's say I'm going long SPXS on Monday. It would make sense to put a stop here at, say, 561. But if you can babysit your stocks, I would probably put an alert at the all-time high on the SPY, 607.03. And when that hits, then I would close my SPXS position. But if you can't do that, then, like I said, you could put a stop at 5.61, and that would be a pullback of 6%, which is, I like to keep my stops under 5%, so that's a little bit of a big stop. You could do a stagger, right? You could do one at 5.75, one at 5.61. Okay, that's a lot of numbers. Let's look at the NASDAQ real quick as well. I'm not as concerned about the NASDAQ. Sure, we had a really ugly day from the Fed. Did bounce pretty nicely, got some accumulation on Friday. But perhaps more significantly, the NASDAQ has been narrow all year, but it has been stable and or maybe even increasing a little bit for the last, since August, about 43% of NASDAQ stocks are above their 200-day simple moving averages. And that looks pretty steady. So as long as we don't see this crack like the S&P 500, and we might, as long as we don't see it crack here beneath 40, I'm really not going to worry about the NASDAQ unless, we see some huge selling action. The NASDAQ is very, what can we say? Only a handful of stocks are propping up the NASDAQ, and those stocks are doing pretty well. I believe it's Microsoft, Google, Tesla, those type of things. So in conclusion, and then we'll look at time decay. If you are a long-term investor trying to build your position in the SPY, this might actually be looked at as a positive opportunity to add more shares in a couple weeks. If you're swing trading the SPY, I personally would consider closing my position, particularly if we break the 50-day here, or counterbalancing it with a short position, perhaps in the SPXS. Okay, time decay in leveraged ETFs. This is from Croc on X. Leveraged ETFs are only meant to be held short term, and it's because of the rebalancing. If you want to screenshot this and read it, feel free, but it has to do with rebalancing and the compounding effect and path dependency, leverage in time, market divergence, etc. So how long can you hold a leveraged ETF? It depends on the market volatility, but in general, 1 day to 4 weeks. At the 4-week mark, you're definitely going to start seeing some decay. So in general, you use leveraged ETFs to go short against your longs, or try to make some quick money in a short amount of time, then you get out of Dodge. You can screenshot this, and if you're a member of my Patreon, I'll put these two articles, I guess, rock posts in the chat for you. All right. Well, I, for one, am looking forward to the next few weeks being over, and then hopefully we get back to strong trading conditions. Like I said, this is a bearish video, and I really do hope I'm wrong, because I do have a long position in the SPY. Let me know your thoughts and comments. If you could also consider becoming a part of my Patreon community, there's a 7-day free trial link in the description below. See you in the next video.